Welcome back to the Strategy Show, the podcast that connects real-world business events with the strategy concepts that actually help us to understand them. It would be great if you could follow the show and feel free to drop a comment or question on the episode. I'm Ben Dixon Green, and today we're going to tackle a tension that's becoming impossible for executives to ignore. Can companies afford to be sustainable when profitability is under pressure? Because for years, strategically, we were told that sustainability pays. But nowadays, that assumption is being stress tested. Now let's start with the numbers, because ultimately strategy always begins with economics. Over the past years, since COVID, energy markets have been volatile. Oil prices have repeatedly approached or exceeded $100 a barrel, even touching $120 a barrel plus. And European industrial electricity prices have, at times, been up to 2 or 3 times higher than pre-2020 averages. Now, think about what that does to a business. If you're running a manufacturing firm, energy can account for anywhere between 10 and 40% of total production costs, depending on your sector. So when energy costs spike, your margins get squeezed immediately. Now, let's layer sustainability on top of that. Transitioning to greener operations often requires heavy capital expenditure in new infrastructure, as well as complicated process redesign. For example, BP has committed up to $55 billion in energy transition investments by 2030, including renewables and low carbon technologies. Shell has also pledged tens of billions towards low carbon energy, but it's also recently scaled back the pace of some of those investments due to profitability concerns. And here's the key point. These green, sustainable investments don't deliver immediate returns. Payback periods can stretch beyond a decade. So in the short term, sustainability can actually reduce a company's return on capital employed, which is a metric that investors watch very closely. Now, let's make this more concrete, ironically by looking at the steel industry. Producing green steel using hydrogen instead of coal can reduce emissions dramatically, but it comes at a cost. Companies like ArcelorMittal have estimated that low carbon steel production can cost 20 to 50% more than traditional methods in the near term. Now imagine you're a steel company that's competing globally against producers who aren't facing the same environmental regulations or who aren't attempting to be more environmentally friendly. They don't have those extra costs of being low carbon. So you have 3 options as a steel manufacturer if you decide to press ahead with those sustainability initiatives. Firstly, you could just absorb the cost, which is going to lead to you enjoying significantly lower margins. Secondly, you could increase your prices. Now, that would therefore mean you could lose competitiveness because you may end up watching many of your customers wandering off to cheaper, high-carbon alternatives. Or finally, you could delay the transition. Now, this would risk future penalties, for example, from government legislation to protect the environment. None of these 3 options are particularly attractive. Or take aviation. Sustainable aviation fuel, SAF, is a major lever for reducing emissions. But right now, SAF can cost 2 to 5 times more than conventional jet fuel. Now, airlines like Lufthansa and British Airways are investing in SAF, but they can't fully pass those costs on to customers without affecting demand. So again, strategy becomes this balancing act between cost, demand, and long-term positioning. And this is why we're starting to see companies adjust their sustainability ambitions. For example, Unilever has long been seen as a leader in sustainability, but it's recently faced investor pressure to improve margins and simplify its business model. Tesla is built around sustainability, but it's aggressively cut prices in recent years to try and maintain volume growth, highlighting that even green companies have to prioritize competitiveness to survive. And in the energy sector, Equinor scaled back some renewable investment targets, citing rising costs and challenges executing its plans. So, what we're seeing isn't necessarily a rejection of sustainability, it's a reprioritization under financial pressure. Now, let's bring in capital markets. Between 2020 and 2022, ESG focused funds saw massive inflows. But more recently, flows have slowed and scrutiny has increased. Investors are asking tougher questions. What's the return on this investment? How does it affect my free cash flow? What's the impact on the company's margins over the next 3 to 5 years? For example, major oil and gas companies have faced a lot of pressure from their shareholders to maintain their dividends, buy back shares, and avoid generally overcommitting to lower return green projects. And that creates this kind of structural tension because if you reduce cash returns to fund sustainability, then your share price can suffer. And if your share price suffers, the cost of capital rises, which ironically makes long-term investment harder. Next up, we have customers and consumers, including you and me. Now, here's where it gets even more complicated. Consumers say they care about sustainability. I would, many of you probably would as well. But behaviour tells a more nuanced story. In multiple surveys across the UK and Europe, a clear majority of consumers claim that they prefer sustainable products, but only a minority are willing to pay a premium above 5 or 10%. And during periods of inflation or cost of living crises, that willingness drops even further. So companies face a contradiction. Sustainability increases costs, but customers resist price increases. Now, not necessarily because they aren't genuine about sustainability mattering to them, but because they're often being squeezed by the same inflationary pressures that the companies are, and there's a limit to how much extra they can afford to pay. And that leaves businesses trying to absorb the gap. So I suppose the question is, given all this complexity, how are firms navigating this? Well, let's look at what's actually happening on the ground. First up, we're seeing more phased investment. Companies are delaying or sequencing investments. For example, we mentioned Shell has adjusted the pace of its energy transition strategy. It's maintaining its commitment, but it's aligning its spending more closely with cash flow performance. We're also starting to see more targeted innovation. If companies are going to spend a lot of money on reducing their carbon footprint, they're focusing this on innovations that both reduce emissions and costs. For example, IKEA has invested heavily in energy efficiency across its stores and supply chain. Now, this reduces its emissions, which is great, but it also lowers its operating costs. So it's a win-win for the company. Because this is the ideal scenario. What you want is sustainability that ultimately pays for itself. The other thing we're seeing at the moment is strategic pricing and segmentation. Some companies are introducing kind of premium green product lines while keeping the standard options for price sensitive customers. Now, this allows them to kind of capture the willingness to pay extra and be ethical where it exists, but also protect volume in the mass market. So your old school product helps subsidize those newer, more expensive green ethical products, like legacy car companies selling old internal combustion engine cars while starting to shift into newer electric vehicles. So what does all of this mean at a deeper level? Well, this isn't just about sustainability. It's about how strategy operates under pressure. Because the core issue here is resource allocation under uncertainty. You're a business that has limited capital, competing priorities from customers, governments, suppliers, competitors, and uncertain future returns and fluctuating costs. And what you need to decide is where to place your bets, and for many businesses, when to hedge your bets. Now, most businesses, I think, are still seeing the need and the benefits of sustainability, but more and more they're facing the practical needs to creatively balance that with managing their current performance. So here's the question I'll leave you with. If sustainability is essential in the long term, but financially painful in the short term, who actually has the advantage? Is it the companies that invest early and absorb the cost? Or is it the ones that wait, protect their margins now, and move later? Because history suggests timing, not intention, is often what separates the winners from the losers. Thanks for listening to this episode of The Strategy Show. I hope you found it useful and maybe enjoyable. If you have enjoyed it and or found it useful, please drop me a follow and put any comments or questions below. Thanks for listening.